Good morning. Welcome to Market Monday. Well, over the weekend, the Wimbledon tennis tournament wrapped up. If you recall during the COVID in 2020, remember, sports seasons canceled, Disney World shut down, and the Wimbledon was canceled too. Then came the news that it had been paying about $2 million a year for the prior 17 years for, yes, a pandemic insurance policy. As we covered previously, that policy ended up paying out over $130 million to the tournament.
While that's enshrined in fascinating COVID history, it brings up an important point. Doing something faithfully, consistently for long periods of time. It can be easy to get caught up in the day-to-day market gyrations or what the Fed's going to do or inflation this, the war that. And those things do matter to a degree. But we believe the stock market serves a greater purpose.
What Matt's saying is we all like to see gains from our stock portfolio. There is no denying that. But we believe a core purpose of investing in the stock market is to keep pace with inflation over long periods of time. Look at this. Here's the purchasing power of the consumer dollar since 1913. Same data since 1960. You can see how the runaway inflation of the 70s really damaged long-term purchasing power. But even after the 70s, it's still a steady march lower. And here's the same info, of course, in just the 21st century so far, since 2000.
And here's the S&P 500 stock market over those same time frames, since 1913, since 1960, and here's since 2000. This one includes the dot-com crash, global financial crisis, Q4 of 2018, COVID, and 2022. The first quarter of this century hasn't been easy as a stock investor, but guess what? It's still way up. And while there are no guarantees, that's what the market tends to do over time.
Folks, which one of these do you think felt safer? In fact, from an investment standpoint, you could consider being in cash as taking no risk at all. Risk-free, feels safe, but to what end? What was accomplished by taking no investment risk? Over time, a complete destruction of purchasing power. So in fact, when we're discussing risk with you, risk is a fuzzy word, isn't it? We're not just discussing investment risk, but also these more insidious forms of risk, like purchasing power risk. Will my purchasing power keep pace with inflation in 30 years from now? Or longevity risk. Will these assets still be there in 30 years to provide me with income?
Chad's making an important point that our objective isn't to blindly minimize risk, it's to take the appropriate amount of risk. We want to take the most amount of investment risk that allows us to stay in the game, to reap these rewards over long periods of time. And of course, your situation is as unique as your fingerprint regarding amount of risk, income needs, cash needs, etc. And for the record, same goes for tax planning. Paying the minimum tax every year is not tax planning. That will lead to other challenges and less than great long-term results. Instead, we want to pay the appropriate amount of tax each year. And that can only be determined in close consultation between you and our team.
And today we'll close with inflation continued slowing in June. Have a great week.